Welcome back to All Things Money. I'm David Blain, and in this third segment, normally we address some of our viewers' mail and email. Actually, we've been doing that this whole show. As I mentioned at the outset, there's a great article in the Wall Street Journal about stock market myths, and we actually had a couple of clients inquire about that. So we're not going to move on to any new questions. We're going to continue answering this question about the client simply asked me what I thought about this article. So we're on the sixth stock market myth, which is the market's really cheap right now. The PE is only fill in the blank, 10, 15, 20, whatever. This is a big misconception that I hear a lot. First of all, the PE can be measured in different ways, and I'm not going to go into a course on how it's measured, but some people use future earnings, some people use past earnings. The company value line, which you may have heard of, uses 6 months future earnings and 6 months past earnings. So first of all, what earnings are we talking about? The PE may be cheap if we're looking at past earnings. It may be cheap looking at future earnings, or it may be expensive looking at past earnings and cheap on future earnings. So there's a lot of ways to manipulate this statistic, and so the first thing you want to figure out is which PE are we looking at? Are we looking at earnings in the past or earnings in the future? Once you determine that, then most people go back to history and look at the historical PE ratio at different times. Well, you have to be careful with this. For example, in March of 2009, when earnings were so depressed, although prices were down, they were not down enough. You had very high PEs if you looked at it, on an instantaneous basis. And so the uninformed observer may have said, wow, PEs are really high right now because companies' earnings are very low, and the prices you're paying, $30 for $1 of earnings. In that particular case, when earnings are so low and depressed, you probably want to take an average of prior earnings or a conservative projected future earnings. Once again, Robert Shiller of Yale University has done a lot of work on what he calls the 10-year median PE. And this basically looks at the average earnings of a company over 10 years of the median company of the, say, S&P 500, and uses that as a valuation measure. And that's one of my favorite valuations for PE is what's called Shiller PE, and it's a very long-term average type PE, and it gives you a good sense of where we are in the market in terms of historically. And so typically at times of very low PEs has been a good time to go ahead and load up in the stock market. The challenge becomes how are you measuring that PE and against what future or past earnings. The seventh myth that we're going to talk about is that you can't time the market. This is obviously brokers want to keep clients fully invested, and that I would agree that it is very difficult. Most people, myself included, are not going to be able to catch the short-term, monthly, certainly not daily, weekly, monthly ups and downs of the market. That is, there are traders on Wall Street that attempt to do that, and I'm sure that some of them are modestly successful. For the average investor or investment advisor, it's just not practical, especially for someone that pays taxes. Even if you are successful, the tax rates would erode the majority of your profits. And so when I talk about timing the market, what I'm talking about is long-term, sort of secular type realization of what type of market that you are in. And it's my belief that you can add value by recognizing, say, for example, in 2000, that we're at a major unrealistic peak in the market, as well as March of 2009, that we're at a major unrealistic bottom in the market. Now, notice I said that it's possible to take advantage of these. We're not concerned about necessarily beating the market, but taking risk off the table, or times when it's a low risk environment. So once again, we're not doing this to necessarily beat the market, but to help manage your risk. And in that case, timing the market over yearly type long-term time frames, it can help to reduce your risk. Once again, we're not saying that you can necessarily beat the market, but it's been shown that you can achieve 80 to 100% of the market returns at being in the market a fraction of the time. What we see is that in times of high volatility, that when markets are going down, you also see markets going up, and so they tend to average each other out, and the vast majority of the gains in the stock market are made when the market is not in a high volatility situation. The eighth recommendation or myth that we hear in the market is that you hear brokers advising, we recommend that you invest in a diversified portfolio of mutual funds. Well, at our firm, we don't use mutual funds to begin with. Number two, they'll put quite a number of different types of mutual funds, and the reality is when you look at the underlying holdings, a lot of them hold the same thing, and there's not a lot of diversification. We would prefer, if you're holding a diversified portfolio, you've got to make sure that you're exposed to different asset classes, such as stocks, large and small, overseas, bonds, high-yield bonds, treasury bonds, corporate bonds. We like preferred stock. We like master limited partnerships, oil and gas. We like commodities. We like real estate. We like gold. That is getting a diversified portfolio. Just picking a U.S. large mutual fund, a large growth, a large value, a mid-cap growth, a mid-cap value that you see promoted a lot in the press, that is not diversification in our book, and that's not going to do a lot to protect you from any downturn. Number 9, this is a stock picker's market. That's another myth that you hear. At different times in the market, as correlations increase, you will see that there is no value added from stock picking. In fact, it's our contention that right now there's very marginal, if any, benefit to picking stocks, that the markets, especially in the U.S. and developed countries, are largely moving as a whole, and there's very little value to be added trying to pick individual stocks. And the 10th myth that we'd like to debunk tonight is that stocks perform over the long term, and simply that the long term, what is the long term? Your life expectancy may not be the long term. Now, in all this debunking of myths, we want to emphasize that we still believe in a good chunk of people's portfolios should be invested in the stock market. Just don't buy into all the myths of Wall Street. Well, that's all the time we have for tonight. For All Things Money, I'm David Blain, and we'll see you next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media.